Hi, welcome back. You're watching Midcap Radar. The going looks good for the market, so let's focus on some sectors then, and that is pharma for the day. Chirag Talati, Associate Director at Kotak Institutional Equities, who tracks the pharma sector quite extensively, now joins in. Chirag, hi. Good afternoon. Good to see you here. Post Q3, the commentary that has come through from the pharma companies, indicates that one, of course, is that the US FDA pressures continue. The whole talk on US pricing, of course, is also quite mixed. Therefore, at your conference now, what are people talking about Q4? I mean, are there any stocks in particular which are looking vulnerable? What's the chatter that you're picking up?
Essentially, I mean, what we're looking at and what we saw in Q3 is the US businesses for most of these guys did kind of bottom out. I mean, we've seen price erosion coming down to a level where it's more manageable. We've also seen volume gains coming out for the Indian companies. They've picked up the market share dislocations happening from the US generic guys. I think from here on, I mean, more from a forward-looking point of view rather than a quarterly point of view, we should see the US basis normalizing from here on. The question really that you see, that you can tend to ask yourself time and again is that what is the realistic number for growth that you should be building in? And that's a number that has continued to disappoint time and again. So what we're hearing is pipelines are good, companies are more optimistic on the future. But at the end of the day, when we do our calculations, we still kind of have a strong view that the US market itself, the growth will come down to a 2 to 4% compounded growth rate over the next 5 to 7 years. So the challenges, the structural challenges of the market remain, but at the same time, we are seeing a bottoming out as far as the performance is concerned.
Chirag, US generic market growth rate should drop to 2 to 4%.
Yeah, I mean that's our calculation that the market growth rate should be somewhere in the region of 2 to 4% for the next several years on a compounded basis. I mean it's down from the last cycle saw a 9% compounded growth rate, but we think it will probably be down to 2 to 4% for the next 5 years.
Okay, so then I mean put that reality, I mean that assumption against what businesses here can do. I mean if the underlying market doesn't grow or grows at that rate, what can businesses which are primarily dependent on that market do?
So I think we have to break it into two parts. One is the US market growth will always be dependent on the degree of patent expirations, because the volume growth tends to be what it is, and there's an element of price erosion. When you look at the Indian companies, right, there's no Indian company now, which is more than $1 billion in sales, say, Aurobindo or Sun Pharma, and you're talking about this being right probably 3% in terms of value-based market share as far as the US goes. So even if you're translating 2% growth for the market over a longer-term period, there's still a decent amount of patent expirations that are there. Plus the untapped market or the non-covered market for the Indians is a pretty large number. So you will see the Indian guys take on share from the global guys, entry into new segments. Plus the pipeline benefits. That is what should translate into growth for the market overall. But yeah.
Chirag, I have your calls on some of the stocks that you track. I see Dr. Reddy's where you have a reduce, Lupin you have a reduce as well. I don't have the one on Sun Pharma, but Cipla you have a buy. So, I mean, does it indicate that perhaps the larger companies, are not looking attractive anymore? Are you looking for value in some of the smaller pharma names?
So, we've had a sell on the sector for a long time. Most of our names were kind of, 12 months back or 6 months back, if you ask me, we were looking at, pretty material downsides. I think, what you've seen actually when we say reduce is a step change. At least we've seen, the cells getting upgraded to reduce, if that's any solace. But our preference still remains for, predominantly likes of Cipla and Torrent, where you got pretty strong domestic franchises which are underpinning the valuation and providing downside support. And in case of Torrent, we think it's a good compounder. There's deleveraging that's going to happen. There's been a phenomenal execution as far as the Unichem deal goes. So that's something that we look as a stable compounder. For Cipla, for us, it still remains our top pick. It's not, of course, delivered as much as it should have. But the US business still is on track to kind of double from current levels over the next several years. There are signs that IV tramadol as a specialty product could actually contribute meaningfully as far as the US sales goes from 22 to 24 time period, and the domestic business is one of the strongest. So these are the two names we do prefer. We actually upgraded Sun from a sell for like 4 years to an add some time back. There too we see valuations kind of coming to a more reasonable level. The only challenge that we see in the sector is that upsides are restricted from here on. So we don't see a lot of upsides in any of the names.
Okay, so why not be a bit more aggressive on something like a Aurobindo? I mean, I'm looking at your valuation multiples. According to your earnings estimates, Aurobindo trades at some 12 times FY20 earnings.
I think look, P is not the right metric to look at, as far as Aurobindo is concerned, because let's not forget that post Sandoz, they'll have a massive amount of debt that will be taken on, and the debt, will be financed at anywhere between 3 to 5%. So when you're doing a large, billion-dollar deal, it will always be EPS accretive, given that the margins are reasonable. However, when you look at it on an EV by EBITDA basis, it trades at a fair value range, and at our 800 rupees target price, 780 rupees target price, it will probably trade at 9.5 times EV by EBITDA. And to put that in perspective, that's actually equivalent or slightly higher than where a Sun is trading right now. So on an EV by EBITDA basis, we don't see a lot of upside as far as Aurobindo is concerned.
Chirag, on Sun, where you have an ad, right? What is the story now? Is it because I read the note, the third quarter note, you were sounding positive. It's earnings surprised positively, but you just said that you don't see too much upside. So one is earnings, and the other is all this other stuff which has been going on parallelly, whistleblower complaint, etc. So what is top of mind and most important there to track?
So I'll keep the other discussions on the side for a moment. I mean, if we look at the business, we do think that, of course, there are challenges as far as the specialty ramp-up is concerned, and we have had our skepticism on most of the specialty pipeline. We think the ramp-up is going to be slower. It's not going to probably be as much as the street expects it to be. But at the same time, valuations have come down to a level where it's reasonable. We think that we are in the last leg, if any, of the downgrade cycle. And at the current valuations, there's the risk reward starts to look favorable with each fall. So that's why we think that there's some upside to be made. As far as the the whistleblower and the other cases are concerned, we think those are more kind of, I mean, we would put them on the side for a moment right now. We actually fundamentals remain as strong as they are. I don't think any of the other issues have hampered the business per se.
Okay, Chirag, it's a pleasure. Thank you very much for joining us and taking us through what you make of the pharmaceutical space. So Kotak essentially has got two buys. One is Cipla, the other is Laurus Laboratories. And they got, what, 3 ads, Sun, Torrent and Aurobindo, some of these stocks we discussed in some detail. Well, we're going to take a very quick break here, but here's a quick note for our viewers on the new rules for DTH and cable, which have come into effect. So you need to choose the channels that you want to by the 31st of March. To keep watching the #1 English business news channel, CNBC TV 18, just call your cable or DTH operator and ask for CNBC TV 18 only for ₹4 per month.